Every time someone buys a Cartier tank and calls it an investment, a fund manager somewhere laughs. Not because watches can be an investment, but because they don't realize that the real investment is when you own a piece of the company behind the watches. The company that owns Cartier, IWC Schaffhausen, Jaeger-LeCoultre, Vacheron Constantin and Panerai, it's called Richemont. And a couple of days ago, they published their full year results. I went through the report, so you don't have to. Before we get into numbers, let's just set the scene. Richemont is a Swiss conglomerate listed on the Swiss Stock Exchange. The portfolio spans three buckets: jewelry maisons, Cartier, Van Cleef & Arpels, Buccellati, Vernier, specialist watchmakers, IWC, Panerai, Jaeger-LeCoultre, Vacheron Constantin, Lange Söhne, Piaget, Roger Dubuis, and until this summer, Baume & Mercier, and a fashion and accessories bucket that's less relevant to us today. When I say specialist watchmakers from here on, those are the watch brands I'm referring to every single time. One thing worth flagging when Richemont talks about the jewelry maison segment, that includes all of Cartier, jewelry and watches. The Santos, the Tank, the Panther, those are inside the jewelry maison's numbers, not the specialist watchmakers. That distinction is meaningful when we get to the margin conversation. A quick note, I'm not telling you to buy the stock, nothing in this video is financial advice, do your own research, speak to someone qualified. Now let's get into it. What I want to do today is walk through what the data actually says. Three things that are going well, three things the numbers flag as problems, and then connect those dots back to what it means for the brands and the market you care about. So when you refer to watches as an investment, you're actually equipped to make that point. Full year sales, 22.4 billion euros, up 5% on paper. Now that 5% matters less than the number next to it, plus 11% at constant exchange rates. Richemont manufactures in Swiss francs, reports in euros, and sells in dollars, yen, yuan, and other currencies. The franc was strong this year, so the reported number got eaten by currency. Strip that out, the underlying business grew 11%. Q4 alone was plus 13%. Operating profit 4.49 billion euros, essentially flat year on year. Net profit up 27% to 3.48 billion euros. That headline number is slightly misleading as the prior year absorbed a €1 billion write-down from selling a failing e-commerce business. So the comparison is flattering. The cleaner read is profit from continuing operations, which was actually down 8%. And the number I keep coming back to, 8.5 billion euros in net cash, no meaningful debt, 4.9 billion euros in cash generated from operations in a single year. That's the financial picture. Now let's get into what's actually going on. Cartier is the second largest watch brand in the world, the second largest by revenue, behind only Rolex and ahead of Audemars Piguet, Patek Philippe, and Omega. According to Morgan Stanley's 2025 industry report, Cartier watches alone generated an estimated 3.49 billion Swiss francs in turnover last year. But here's what makes that number interesting in the context of this report. Cartier's watch business doesn't sit inside the specialist watchmakers segment. It sits inside the jewelry maisons, and that segment posted 16.5 billion euros in combined sales, up 14% at constant rates with a 30.5% operating margin. Double digits in every quarter, every region or year. For every 100 euros of jewelry maisons sales, 30 euro 50s flows through as operating profit. They did it by raising prices when gold costs went up and customers didn't blink. And that is pricing power in action. 8.5 billion euros. That's how much cash Richemont has sitting on its balance sheet right now. And it's been growing every single year, from 5.25 billion euros in fiscal year 2022 to 8.5 billion euros today. They generated 2.82 billion euros in free cash flow this year alone, up 570 million euros on last year. To give that some scale, the entire specialist watchmakers division generated 107 million euros in operating profit this year. The balance sheet holds 79 times that amount in cash. What that means in practice is that Richemont doesn't need to cut when the watch market goes soft. They can invest through a downturn, and the data shows exactly that. 1 billion euros in capex and R&D, up 20% to 102 million euros in a year when the watch division was under pressure. We'll come back to that R&D number shortly. 10 years ago, every luxury earnings report had China at the center. The Chinese consumer was the engine. This report tells a different story. Americas grew 17% at constant rates, double digits every quarter, including plus 18% in Q4. It now represents 25% of group sales, and both jewelry maisons and specialist watchmakers grew by double digits in that region. Looking at the Morgan Stanley data alongside the report, IWC at 573 million Swiss francs and JLC at 523 million Swiss francs sit almost identically in scale, both ranked in the global top 15. The Americans being their best performing region investment right now is meaningful for those two brands specifically. The US domestic luxury consumer is doing the heavy lifting in ways the headline group number doesn't make obvious. This video is a bit different from what I usually do, so if you're enjoying it, like and subscribe, and if you want to see more of this kind of breakdown, comment thank. Now, the three things the data flags as problems. The jewelry maisons operated at a 30.5% margin. The specialist watchmakers operated at 3.4%. Jewelry maisons generated 5 billion euros in operating profit. The entire specialist watchmakers segment generated 107 million euros. Operating profit dropped 39% year on year, and remember that Cartier watches aren't even in that number. They are in the 30% margin segment. What's driving it isn't mismanagement. It's a fixed cost problem. These brands carry manufacturing infrastructure, skilled craftspeople, ateliers, costs that don't scale down when demand softens. Asia Pacific and Japan both declined for specialist watchmakers this year, and those markets carry significant weight for those brands. The Morgan Stanley data helps show the individual brand scale here, all in Swiss francs. Panerai at 299 million, Lange at 240 million, Piaget at 213 million, Roger Dubuis at 51 million. These are relatively small revenue bases to carry fixed production costs against. The one encouraging signal, Lange, JLC and Vacheron all showed sequential improvement in the second half of the year. Direction of travel is better, but the margin issue is real. Three things are squeezing Richemont's gross margin at the same time, and none of them are going away quickly. Gross margin fell from 66.9% to 64.4%, a 250 basis point drop. 2/3 of that come from gold prices, a direct input cost for a company that makes jewelry and metal watches. 1/3 come from US tariffs, and on top of both of those, an additional 210 basis points from foreign exchange movement, the strong Swiss franc against a weaker dollar, yen and yuan. They partially offset through measured price increases, and they worked, but foreign exchange is much harder to neutralize. They hedge 70% of exposure on a rolling 12 months basis, but you can't fully eliminate it. This isn't a demand problem. Nobody stopped wanting a Cartier because of the Swiss franc USD exchange rate, but it is a structural margin headwind that shows up in the numbers regardless. As we already know, Baume & Mercier is leaving Richemont, sold to the Damiani Group, announced in January, closing this summer. They took a 59 million euros write down on it in this report. I'll be honest, I have a soft spot for that brand. My very first watch was a Baume & Mercier Clifton, and I've been meaning to make a video on that for a while, so that's coming. But looking at the data, the sale makes strategic sense. Baume & Mercier was the accessible entry point in the portfolio, predominantly multi-brand wholesale, price-sensitive positioning, structurally out of step with where the rest of the specialist watchmakers operate. The broader boutique count for specialist watchmakers fell by 24 doors in the year. Panerai lost 17, Piaget lost 9, JLC lost 6. This is deliberate. Fewer, better doors, less wholesale dependence. Direct to client is now 77% of group sales, up from 71% 2 years ago. Fewer units through wholesale means fewer pathways to the grey market. If you've watched secondary prices on certain Richemont pieces stabilize over recent quarters, the distribution strategy is part of why. A few things stand out when you connect the data to what's actually happening in the watch world. The R&D line going up 20% from 85 million euros to 102 million euros in a down cycle for the watch division is not accidental. Vacheron's 270th anniversary traditional and patrimony pieces, JLC's reverso tributes across multiple references, Lange's 1815 tourbillon in platinum, all called out specifically in the report. But it's reasonable to connect that R&D investment to what we've actually seen released these years too. The new JLC Master Control, the Vacheron Overseas Ultra Thin in platinum, the Overseas Cardinal Points lineup. That level of engineering doesn't happen without sustained investment. R&D goes up 20% in a soft year, tells you where the conviction is. Look, if we're being honest with ourselves, most watch purchases aren't investments. What we just talked about is. But I truly don't think you should have to justify buying a watch because it holds value or appreciates. If you love it, that's the whole conversation. I'm totally guilty of purchasing pieces that will be considered bad investments. They're sitting in my collection, they're not going anywhere, and I don't regret a single one of them because they make me happy, and to me, that's what counts. The brands you love are not abstract objects. There is a business underneath them, and now you've seen what it reported this year. I hope it makes you appreciate them just a little bit more. If you want to see what some of those brands have released this year, I've got a hands-on video with new watches from 4 brands. Link is on screen right now. Like and subscribe, and I will catch you in the next one. Cheers!